What would you call it when a small country sits across the table from the world's largest economy, tries to defend its national interests, and walks away with a deal that half the country believes is a defeat? Is it a tough but necessary compromise? A geopolitical trap? Or simply the unavoidable cost of navigating a world shaped by superpower rivalry? This is the dilemma Malaysia finds itself in today. The new US-Malaysia tariff agreement has sparked a fierce national debate, with critics claiming the country has been cornered and forced to concede far too much to Washington. But is Malaysia truly on the losing end of the bargain? Or did it manage to safeguard its core interests in an increasingly volatile global economy? In this video, we unpack how Malaysia found itself pulled into a high-stakes geopolitical struggle, why critics argue the United States outplayed Kuala Lumpur, and how Prime Minister Anwar Ibrahim's administration defended the deal. Stay with us until the end to find out what this tariff deal truly means for Malaysia's future. On 1 April 2025, US President Donald Trump launched what his administration dramatically branded as Liberation Day, a sweeping overhaul of America's global trade relationships. That day, Washington imposed aggressive new tariffs on roughly 90 countries, framing the move as an effort to restore fairness in trade. But around the world, the reaction was very different. Many saw it not as liberation, but as the opening shot of a tariff war that could destabilize entire regions. In Southeast Asia, countries like Cambodia, Laos, Vietnam, and Myanmar were hit the hardest, facing tariff rates exceeding 40%. Malaysia fared slightly better, but the US still imposed a steep 24% tariff on its exports, a higher rate than those levied on neighbors such as Singapore and the Philippines, and a serious threat to an economy deeply reliant on global trade. Prime Minister Anwar Ibrahim's administration quickly realized that ignoring the situation was not an option. With the US serving as one of Malaysia's largest trading partner, top foreign investor, and a vital market for high-value sectors such as semiconductors and electronics, the stakes were simply too high. The new tariff imposed could trigger factory shutdowns, job losses, and capital outflows. Yet Malaysia also needed to protect its diplomatic posture. For decades, the country has prided itself on a foreign policy of non-alignment, carefully managing ties with global powers without appearing to take sides or surrender autonomy. The challenge was clear. Malaysia had to engage in negotiations to safeguard its economy, while avoiding any move that could be seen as capitulation. This tension shaped every step of Malaysia's negotiations with Washington. After months of difficult talks, Malaysia secured a reduction in tariffs from 24% down to 19%, roughly in line with regional peers and below the level initially threatened. To the government, this was a victory. It prevented a worst-case scenario, protected key export sectors, and avoided punitive actions that could cripple long-term competitiveness. Malaysia even secured exemptions on approximately 1,700 tariff lines covering palm oil, rubber, cocoa, pharmaceuticals, and aircraft components, sectors worth billions to the economy. But there was a catch, several catches, in fact. The fine print of the agreement on reciprocal trade between the US and Malaysia revealed clauses that critics say go far beyond typical trade negotiations. These clauses sparked the backlash that dominated Malaysia's national conversation. The first controversial area involves enforcement. Malaysia is required to help prevent violations of US tariffs and trade measures, including cracking down on what Washington claims is significant origin washing, where goods from countries like China are rerouted through Malaysia to bypass US tariffs. The US expects Malaysia to enforce American trade rules within Malaysian borders. Critics argue this shifts Malaysia from an independent trading nation to a policing extension of America's trade war. Second, the deal includes alignment with US export controls, sanctions, and screening measures related to national security. In other words, if Washington blacklists a foreign company or blocks access to certain technologies, Malaysia is expected to implement similar restrictions or enact complementary measures that achieve the same effect. To critics, it's a deeply intrusive requirement that ties Malaysia's policies to American preferences. The third and most explosive issue is the catch-all clause. This clause states that Malaysia should avoid entering agreements that jeopardize essential American interests. The text does not name specific countries, but nearly every analyst believes the unnamed elephant in the room is China. Even more controversially, the US reserves the right to terminate the entire trade agreement and reimpose higher tariffs if Malaysia signs trade deals with countries Washington deems problematic. Many believed that the inclusion of this clause signals the US desire to keep Malaysia within its economic orbit and prevent closer integration with China. Malaysia also agreed to slash or remove tariffs on most of US imports, granting American goods preferential access, and committed to spending up to $150 billion over the next 5 years on US semiconductors, aerospace components, and data center equipment. Adding to the stakes, Malaysia promised not to restrict exports of critical minerals and rare earth elements to the US, ensuring America's steady access to these strategically vital resources. It was this combination of sweeping economic commitments and strategic concessions that ignited a storm in domestic politics. Former Prime Minister Mahathir Mohamad, long known for challenging Western dominance, delivered one of the harshest criticisms. He argued that Malaysia had conceded too much control over its economy, industrial policy, and freedom to trade. He warned that provisions requiring alignment with US restrictions effectively meant surrendering Malaysia's autonomy. Mahathir accused the government of agreeing to conditions that would force Malaysia to buy American goods and follow American digital rules, while granting the US preferential access to Malaysia's rare minerals and markets. Opposition leader Azmin Ali echoed similar concerns. He argued that the clause on third country sanctions would force Malaysia to follow Washington's lead, even if such actions harmed Malaysia's economic interests. To him, the agreement dragged Malaysia into conflicts that had nothing to do with its own survival. He insisted the deal undermined Malaysia's non-alignment policy, one of the country's most important diplomatic pillars. Civil society organizations, such as Malaysia's C4 Centre, voiced concerns that the agreement could sidestep existing procurement safeguards and weaken scrutiny over foreign investments. They warned that certain provisions risk giving Washington excessive sway over Malaysia's domestic decision-making, particularly in situations where policies impacting US interests would require prior consultation or alignment with American preferences. Analysts also noted that unlike Cambodia's similar 19% tariff deal, Malaysia's agreement lacked explicit references to protecting sovereign interests. Cambodia's deal included such language. Malaysia's did not. Critics framed this as evidence that Malaysia accepted stricter conditions than necessary. But the government pushed back hard. Prime Minister Anwar Ibrahim insisted Malaysia had not given up its sovereignty. He argued that the deal contained exit clauses, allowing Malaysia to walk away at any time if the arrangement no longer served national interests. He reminded Malaysians that the country needed continued American investments and that refusing to negotiate risked catastrophic tariffs. According to Anwar, the agreement provided stability, predictability, and access to the US market at a crucial moment. Trade Minister Tengku Zafrul Aziz sought to calm public concerns by explaining that the alignment provisions in the agreement were limited in scope and focused only on areas where both countries shared common interests. He stressed that Malaysia would not be required to mirror US actions automatically, as all decisions would still be anchored in Malaysian laws and assessed through Malaysia's own legal and economic considerations. According to him, any cooperation with Washington would stem from mutual benefit, not unilateral pressure. He added that Malaysia had maintained firm boundaries during negotiations, safeguarding its sovereignty and preserving its relationships with other international partners. But the key question remains: did Malaysia really have a choice? This is the uncomfortable reality underlying both the criticism and the defense. Malaysia's economic structure is deeply intertwined with global supply chains, especially the semiconductor ecosystem. Its reliance on the US for technology, investments, and markets creates asymmetry. Losing access to the US market or facing prolonged high tariffs could cripple entire sectors. Meanwhile, Malaysia enjoys exceptionally close economic ties with China. For more than 15 years, China has remained Malaysia's largest trading partner, with bilateral trade exceeding 480 billion ringgit in 2024. Chinese investment continues to pour into strategic sectors such as manufacturing, infrastructure, renewable energy, and digital technology, highlighted by flagship projects including the East Coast Rail Link and the Malaysia-China Kuantan Industrial Park. These deep economic connections require Malaysia to carefully balance its relations with both China and the United States, skillfully managing great power dynamics while protecting its own interests. In this context, proponents argue that Malaysia's hands were tied. The US had leverage, and Malaysia navigated the situation with caution rather than bravado. When the Trump administration launched tariffs on multiple economies, Malaysia avoided the most severe outcomes by keeping diplomatic channels open and resisting retaliation. Malaysia also succeeded in securing tariff exemptions on goods that matter most to its economy. Critics, however, respond that acknowledging a difficult geopolitical environment does not justify accepting terms that could lock the country into long-term dependency. They argue the alignment clauses set a dangerous precedent, carving out new pathways for American influence over Malaysian policy. Even if these clauses are never enforced, the very act of signing them signals a shift in power. The most nuanced analysts believe both sides have valid points. Malaysia has not yet lost sovereignty, but the risk of erosion exists. The alignment clauses give the US a legal basis for future pressure, especially if Malaysia signs deals with China or other strategic rivals. Whether Washington uses this leverage depends on future geopolitical tensions. For now, Malaysia retains room to maneuver, but its space has undeniably shrunk. Another point to consider is the regional context. Thailand and Vietnam have yet to finalize their agreements with the US at the time this video was released. Their initial terms, as publicly stated, do not appear to include clauses as intrusive as Malaysia's catch-all alignment provisions. If their final deals end up less restrictive, Malaysia may appear to have conceded more than necessary. However, it is also possible that Washington will demand similar clauses from other Southeast Asian partners, using Malaysia's agreement as a template. In that case, Malaysia would not be an outlier, but an early participant in a broader US strategy to counter China's influence in the region. Meanwhile, Malaysia has been repositioning itself economically to strengthen its resilience. Finance Minister Amir Hamzah explained that Malaysia's diversified export portfolio shielded it from major shocks, and that no single market, including the US, accounted for more than 30% of its exports. Malaysia has performed strongly in recent quarters, balancing fiscal responsibility with targeted investments. It is also pushing to move up the value chain, investing in chip design, advanced manufacturing, and greener energy systems. Its decision to join BRICS further reflects this strategic shift. By deepening ties with emerging economies and expanding access to alternative financial and trade networks, Malaysia aims to reduce its exposure to geopolitical volatility. These long-term efforts are designed to make the economy more stable and less vulnerable to shifting power dynamics on the global stage. So where does this leave Malaysia? At a crossroads, caught between immediate economic pressures and long-term strategic independence. The tariff deal did not destroy Malaysia's sovereignty, but it narrowed its margins. It did not turn Malaysia into an American satellite, but it signaled a tilt that will be closely watched by both Washington and Beijing. It did not hand over control of Malaysia's economy, but it introduced clauses that could limit future policy choices. The most honest conclusion is that Malaysia walked into a storm it could not fully avoid, and emerged with a deal that solves one problem while potentially creating several others. Ultimately, the question Malaysians must ask is this: in an era where superpowers weaponize tariffs, technology, and market access, how much room does a middle power truly have? Only time, and the next chapter of US-China rivalry, will reveal the true cost of this agreement. But Malaysia is not alone. Across the causeway, Singapore is grappling with similar turbulence triggered by America's unilateral tariffs and its intensifying rivalry with China. In fact, Singapore's Prime Minister, Lawrence Wong, was pressed on these dilemmas during a Financial Times interview in October 2025. Curious to see how he handled the toughest questions? Watch the next video to find out.